All right, I think we got everybody in the class now. So again, my name is Jason Maida. In case you missed it, I'm the branch manager here with American Pacific Mortgage. Really excited to get connected with you guys tonight to share a little bit more about first-time home ownership. So we teach classes just like this once a week from our offices right here in Sacramento, and they're broadcast all across the country through our different partnerships. Many of you are probably joining tonight's class because of our Sac State partnership, which we're super proud of. But this class and all of our classes are open to the public. So we just want to help educate our communities on home ownership. So a little bit about me. Again, I am the branch manager with APM based out of here in Sacramento, and I specialize in first-time homebuyer education. So that's kind of what I do. And a lot of what you're going to learn tonight is not only the tips and resources and support around buying your first home, but we're going to spend some time also talking about first-time homebuyer assistance program. So we partner with CalHFA, which is the California Housing Finance Agency, designed to help low to moderate income households. So we're going to talk a little bit about CalHFA tonight as well. So here is our talking points for tonight. So we're going to look at the housing market today, a lot going on there, spend some time looking at interest rates, especially there's a lot of kind of volatility, if you will, in today's markets. So I'm going to share with you kind of what happened there and what we expect as a going forward. We're going to launch into tonight's discussion looking at a rent versus buy calculator. So we're going to talk about budgeting and what that can look like for you. We always want to kind of spend some time looking at, what is buying and does it make sense for me? So we'll spend some time there. We'll also talk about credit, how to optimize our credit to make sure we're in the best possible position for our home purchase. Talk about student loans, different programs that are available to you as not only first-time buyers, but even second or third-time buyers. We'll talk about documentation needed for home buying, those assistance programs. You guys may have heard about the California Dream for All program. We had one version of it that launched earlier this year. Funds, of course, ran out on that, but we'll kind of share with you a little bit of a tidbit of that information. We also have another class that we're going to be doing for that program and other CalHFA programs on July 19th, but I'll give you a little bit of a kind of a preview of that. And then we'll wrap up tonight's discussion talking about the process of buying a house. So what does it look like? So if I'm going to kind of go through this process with our team here, what are the milestones that I'm going to go through? So I'll walk you through that. And then as we're wrapping up tonight's discussion, I want you to kind of get a better understanding of what's next for me in this journey towards home ownership. So what do I need to do to take those next steps? Okay. So again, very interactive session. We encourage the questions, but I'll do my best to answer all those questions live on air with you. And then at the end of tonight's class, we'll spend some time answering anything that got left behind. Okay. So the first kind of takeoff point for us is we want to kind of think about home buying and does it really make sense for me? So you're joining tonight's class because you're just kind of thinking about maybe home ownership is something for me. Now, whether it's this year or in the years beyond, we want to kind of get a sense of what it could possibly look like for me. When we're thinking about buying a house, it's probably going to be one of the biggest investments we make in our upcoming financial futures. When you buy a house, you create stability with your housing payment. You have an asset now, so that asset grows in equity. So now you have something to pass along to maybe your family, the heirs of your estate. And that equity is created by market value going up. And then obviously you pay down the principal balance of your loan. That delta, or the difference, is what creates equity in your home. And there's still some great tax benefits that come along with owning a home. So those are things we don't want to overlook. So when we think about owning a home and maybe the budget that we're going to have to build for buying our house, it's not necessarily what I would say is like an apples to apples comparison, because we're going to have to take a look at, what are some of the things that are the key ingredients for owning a home, and what are going to be the difference makers for me when I think about my monthly budgets. It's not going to be simply just, hey, I'm paying $2,000 in rent now, I'm going to pay $2,000 in my mortgage, because there's all these great things that come along with ownership that we don't necessarily get in renting. So I want to walk our audience through this budget analysis, or a rent versus buying calculator. And so we're going to kind of dive into this now. I just started sharing my calculator screen here with you. And in case I didn't mention this to you earlier, all the material that we share with you this evening, we're going to go ahead and email that out to you tomorrow. So like all the slides, all the calculators, all the helpful links and resources, you'll get those tomorrow morning. Okay, so let me kind of walk you through the calculator and kind of show you how we get to some of these numbers. And so we'll start off by kind of adding in, or we've already kind of pre-populated some of this stuff, but I'll explain to you what each point means. So first of all, on the rent side of things, we're going to plug in $2,000 as a rent baseline here for us. We have our monthly renter's insurance. We're going to factor that at $15 a month. We have our rent expected to increase 3% year over year. Many of you joining tonight's class probably have already seen your rent even kind of go up quite a bit just as you're re-signing those lease agreements perhaps. And then we have the home purchase price. So we're going to put in $400,000 as a baseline. I know a lot of us on tonight's class are kind of at different levels in terms of what I'm paying in rent or what I'm willing to pay in terms of house. But I want to give you just a little bit of an idea of kind of the logic behind the rent versus buy calculator. The minimum down payment for a first-time home buyer is 3%. So that is what the minimum amount we can do on a conventional loan. And we're going to talk about programs and the guidelines for those in just a minute. Property taxes, we generally want to factor property taxes at 1.25%, give or take, of the purchase price. So that's going to be factored into our budget. We have our homeowner's insurance expense. So when we think about homeowner's insurance, that's going to protect our home against, fire, vandalism. Some cases you may want flood insurance. In California, you have earthquake insurance. Many of you may have heard with some of the major carriers refusing to insure in California or saying, hey, we're not going to no longer write policies here. So, insurance is something we have to factor in. It can be expensive. But I think, realistically on a $400,000 house, somewhere around $1,000 to $1,500 a year is pretty reasonable. You have maintenance costs. We have plugged in about $700 per year. Then we're going to hit the tab for loan information. And so for loan information, we're going to assume a 30-year fixed mortgage. Most of our first-time buyers are going to do a 30-year mortgage. In very rare cases, we may look at a 20-year or 15-year fixed mortgage. Now we're going to plug in interest rates. Interest rates are up a little bit today, so I'm going to plug that at. I'm going to put that in at 6.875. I'll just kind of explain to you how we get there in just a second. And then we're looking at origination charges. So when we think about origination charges, those are going to be the costs that you'll pay in your financing as part of the overall closing costs. So there's two key things that we have to save for when we buy a home. There's the down payment, which we now know is 3%. And so in this example we have here is $12,000. And then we have closing costs. Closing costs can be anywhere between 2 to 3% of our purchase price. Now, one of the great things about Sac State and the partnership we have with them is that we provide a discount of $750 in our closing costs because of the alumni partnership. So that's something we really encourage you to check out. We'll spotlight that a little bit more on at the end of today's call. And then we're going to talk more about this in just a bit when we get into interest rates, but you also have the option of what we call discount points. That's when you pay additional costs to help bring down the cost of your interest rate. So if I have a rate of 6.875, but I really want to get my rate down to 6.25, I can pay additional costs, which we call discount points, to help bring down that level of interest rate. So there's a little bit of a trade-off. Now, usually 1 point is 1% of my loan amount. And then that 1% cost that I'm paying generally will equate to a 0.25% reduction in interest rate. So if I pay 2 points or 2%, I'm probably going to get about a 0.5% reduction in interest rate. So that's kind of the usual rule of thumb. So that's called discount points. We also have other settlement services in here. So that's also part of closing costs. When we think about that, that's going to be our title policy, escrow, maybe some of the government charges like transfer charges, or maybe recording fees. So those are all kind of capsulated in settlement services. And then we have other assumptions. So those assumptions will include how much our house is going to go up in value over time. Now, in this example, I put in that we're going to have this home for 7 years, and then my expected appreciation rate is about 4%. And then we have the selling costs of our home. And what we're thinking about there is that when I eventually sell my home in 7 years, I'm going to have costs that I'm going to have to pay. So those will come out of my net equity out of my home. Now, one of the great things about buying your first home or your second home, whatever the case may be, when you get representation from a realtor, those expenses are paid for by the seller. Now, eventually, when I decide to sell my home, I'm going to have to pay those same realtor expenses. But at least for now, there is no cost for the representation of a realtor. Then we have state and federal tax rates at 33.8. That will change based upon, obviously your income levels. And then we have a savings rate of 1%. So what the calculator does in simple terms is it first of all stacks side by side our cost of renting which is, we know, $2,000 a month, versus our cost of owning, which is about $3,500 a month. So there's about a $1,500 swing in increase in payment. But what that also shows us is that over 7 years, we have an opportunity of about $53,000 by purchasing a home versus renting over time. Okay, so that's where, when we think about, the opportunity to purchase and maybe that budget increasing a little bit, it's not necessarily that apples to apples comparison. So we want to factor in things like appreciation, tax benefits that come along with owning a home. Okay. And I saw that our stream was kind of getting a little slow. So we hard lined in. So hopefully that'll pick up for you guys. So sorry, maybe I was talking quick too, and maybe it'll catch up or something. Who knows? But we should be good to go now. All right, let us know. Feel free to comment in the chat if you feel like we're still going slow here. So, all right, so that's our rent versus buy calculator. So we'll get that material out to you as we send out all the slide information tomorrow morning. Okay, so now let's talk a little bit about the housing market in Sacramento. Since we live and work right here in Sacramento, I got obviously a pretty good feel of the market, just as being a resident here. And so, I think ultimately when we look at the market right now, it's very similar to what we're seeing across the country, which is, it's more so, just a product of lack of inventory right now. We don't have as much inventory on the market to be able to help support the buyers that are in the market. Now, you would think with interest rates, which we're going to talk about in just a second, are kind of getting buyers to get on the sidelines a little bit, but there's still a lot of activity out there. The market goes through cycles and, or seasonality in the market. And so the spring and summer months are generally the busier months of the year. And so this summer, for example, is not as fast paced as we've seen. I think interest rates are having a little bit to do with that, but I think more so is just the inventory levels we're seeing in the current market. So our slide here kind of shows you what the median price is doing in the Sacramento area. So you can see a little bit of decrease year over year, 49 on the median sales price. Days on market, 10 days, which obviously things are coming off the market pretty quick. Buyers are seeing something that they like, they're jumping on it. A lot of multiple offers out there right now. So we're seeing, 10, 15 offers that are out there in the marketplace right now. So, okay, we had a question that came in. Can we see the trend line within the past 5 years? I don't have, I just have a screenshot on this. So you can see our resources that are cited here at the bottom here. So you can kind of go check out those online for yourself. We don't have the 5 years. So that was one of our questions in the chat. But, I think just looking at what the market has done recently, I think is really kind of a telltale sign of really, we just don't have a lot of inventory on the market, and that's creating multiple offers that are out there. So this is representation of, May of last year to, May of this year. So we just got that 1 year look at things. But, what's interesting is that, right here is kind of where we saw interest rates start to slide upwards. And then, we saw interest rates start to move down, but this is kind of showing you seasonality in the market. So winter months, we're not usually seeing a lot of buyers. Seeing a little bit of a pickup in February. This was fueled primarily by, a little bit of a more favorable interest rate environment. We saw some growth here, and this level was attributed to the California Dream for All program, which we'll talk about in just a second, and later in tonight's class. And then, this is kind of attributing to more of the seasonality in the market. But, I think the question always is it now the right time to get into the market? So, I think everyone's looking for that perfect storm, if you will, low home prices, low interest rates. Very tough to obviously accomplish that. We're not going to see what we saw in, 2020, 2021. And at the same time, when at that level of interest rate that we're seeing, obviously home prices were getting overbid $50,000, $100,000. And so I think when you look at, your opportunity to purchase, everybody's situation is going to look a little bit different, right? And I think it's really important to examine all the options that are available to you in the market. Now, when it comes to interest rates, I think we got to see what interest rates are doing right now. And, today was a little bit of a rougher day in interest rates. We saw the 10-year Treasury move past 4% today, and it really kind of vaulted up interest rates into that 7% range. Now, the market really came out pretty, aggressive with the 10-year going up pretty high earlier in the day, came back down, Mortgage interest rates didn't move as much by the end of the trading day, but it's still a very volatile market right now. And so when we kind of look at how we got here, I want to kind of go back a little bit to 2020. And obviously we know in 2020, we as communities experienced the pandemic, and that obviously pushed us into a lower interest rate environment. We saw at the bottom of the interest rate market to the latter part of 2020, which rates touched down at 2.5%. That was the lowest level that we've seen. So that was unprecedented lows. And then eventually, as we kind of pushed into 21 and then 22 is where we saw interest rates really start to vault up. So now we started to go from that 2.5, now we're at 3.5, 4.5. And then by the time we got to Q4 of 2022, now we saw rates start to push into 7% range. And that's where you can see this big move upwards here. Now, why is that happening? Well, a lot of it's attributed to what's going on with inflation. And the Federal Reserve is trying to combat inflation by raising interest rates. In the last Federal Reserve session, there was a pause on interest rates. Now there's another session that's going to be in July. There's about an 80% chance they're going to raise rates again in July. So, that's putting a little bit of pressure on mortgage interest rates right now. So we're going to have to see how things kind of play itself out. Today, we had a bigger job number than we expected in terms of jobs created, which really kind of set some panic to the market because now it shows the signs that maybe the economy is still able to withstand interest rate hikes with strong job numbers. So that's putting, like I said, a little bit of pressure on interest rates, but we'll have to see how this kind of market goes out, kind of plays itself out. I think long-term, what we probably see is interest rates falling in that low 6s range. We'd love to get to the high 5s at this point, but we're probably still in this cycle for about a year or so as we kind of see kind of a fast forward look at the market. Now, interest rates are not all the same for all products or all clients that are looking at mortgage financing. There's some characteristics that are really important for you guys to understand. First thing, credit score plays a role in the available interest rate for you. So the higher my credit score is, the better my interest rate could be. The product that I'm elect, whether it's an FHA or a conventional loan, or maybe it's a VA loan, those can all play a role in interest rate. How much I decide to finance, what my down payment is. So if it's 3% versus 20%, that could change my interest rate. And then how much cost am I paying with my loan to maybe buy down my interest rate? So we talked a little bit about that earlier, discount points to help bring down my interest rate. And then the type or the term of my loan can also influence my interest rate. So if I go from a 30-year fixed mortgage to a 15-year fixed mortgage, that could potentially bring down my interest rate. Now, when we meet with you for a consultation to design a home buying plan for you, that's when we kind of figure out the best solution for you based upon your goals and objectives of home ownership. But, that's how we kind of get to interest rate. So I think it's really important as first-time buyers to understand, what are some of the ingredients to make up interest rate. And so one of those bigger things that we talked about is credit. And credit is going to be an important component of home ownership, right? And, credit will drive costs of everything for us, whether it's, the availability to be able to rent a place, whether it's be able to get my utilities set up, to be able to get my cell phone set up, buy a home. All those things are driven off of credit. So, and when we think about, buying a house and the score calculation that we use for home financing, I want to kind of walk you through that. This kind of calculation kind of shows you the weighting of the mortgage score. Now, there's 3 different scores that are available to you or that are used in financing. There's the credit card score. By the way, the credit card score is the one that's used for most of your viewing that you see on credit cards, like credit monitoring, like Credit Karma. You have auto financing credit model, and then of course you have the mortgage model. Now, this is no plug for Experian, but I would encourage you to check out Experian. Experian has some pretty cool tools to be able to see the different models, as you're kind of examining your credit and kind of how to optimize your score. Let's look at the FICO score calculation. So 15% of the score calculation is going to be how long I've had credit. So the more mature my credit file is, the potential higher my score is going to be. 20% is going to be how much credit I have in use, but also new credit I'm trying to obtain, also known as inquiries. So the more inquiries or more accounts that I'm trying to get, more inquiries that I have, the bigger impact I'm going to have to my credit score. 30% is going to be how much I owe, or also known as utilization. So we're looking at specifically at revolving accounts when we think about utilization. So if I have $10,000 in limits, and my balance is $5,000, I'm at 50% utilization, right? So ideally, I want to be at least, well, first of all, if I'm running a higher utilization level, I at least want to be below 50% utilization. My optimal level is below 10% utilization. Let me give you a quick little tip when it comes to managing utilization. So when you think about, that credit limit and you have your credit balances, your credit card issuer has a billing cycle date on each one of your credit cards, and they have a due date, right? Now, if I'm, in the habit of paying my credit cards off or down on my due date every month, that's totally fine. But the challenge with that is that the credit card issuer sends out all the payment information, all the balance information out to the credit bureaus at the end of your billing cycle date. So in theory, your balances may show a little bit higher on your credit report than they really are, because you're paying them off on your due date. So what I would encourage you to do is, if you can try to pay down or pay off your credit card amounts before you get to your billing cycle date, then you're going to have a much higher credit score, because now you have lower utilization, you reflect that great payment history, and then hopefully we have a much improved credit score. Okay, so just a little tip on how to kind of manage utilization. Now, the last component is payment history, and that's how I pay my bills, right? So if I've had any late payments, maybe they could be a 30-day late, they could be a 60-day late, maybe even a 90-day late. Those are all things that can impact your score. Usually when you've had lates in the last 12 to 24 months, those are going to be the biggest impact to the credit score. Now, every loan program has a minimum credit score requirement. So FHA loans are going to be 580 for the conventional products. So when we think about conventional loans, that's the Fannie Mae or Freddie Mac loans, minimum score of 620. VA loans also have a minimum score of 620. So VA loans are going to be for our veterans that have served. So that's the Veterans Administration loan product. And then CalHFA, which is first-time homebuyer assistance programs, minimum score of 640 for FHA, 680 for the conventional product. And then, when you look at your credit profile in general, and you look at the length of credit, there's also some things that can impact your score from that perspective as well too. So account closure is one of those things. So if you were to close out an account that you've had for, let's say, 10 years, when you close out that account, that also pulls away all the great history that you've had in the maturity of that account on your credit report, and also can actually negatively impact your utilization. Because if I pull away a 10-year-old credit card out of my aggregate limits, then let's say it's $5,000, then that lowers those limits by $5,000. And then I'm impacting that amount owed component of 30%. So we want to be careful. We don't want to close out credit cards if at all possible by doing, balance transfers or anything like that. And when we look at credit scores in the lending world, we take the middle score of all three bureaus. Now, the three agencies that report are Experian, there's Equifax, and there's TransUnion. So if I have a 740 is my best score, 720 is my middle score, and then 700 is my lowest score, we're going to use 720 as the score for evaluating the eligibility. Now, if I'm going to apply with my partner, and my partner has a 700, 680, and 660 score, now we're going to take the lowest middle score between the two of us. So now my partner's score of 680 will be used into the calculation. And that's important because that could impact the interest rate that I'm able to get. It could also impact the mortgage insurance that I can achieve on my loan. So all those things are super important when it comes to the design of your financing. A couple more things on credit, and I want to share with you this matrix about how long negative things will stay on your credit report. So hard inquiries will be there 2 years or less. You have late payments will be 7 years or less, but the impact to the score was within the last 12 to 24 months. I forgot to mention to you about inquiries, because that's really important too, because hard inquiries are those inquiries that are going to impact your credit score. Now, when we start our process to evaluate pre-approval options for you, we're always going to start with a soft inquiry. So, that doesn't have an impact on your credit score. You really want to limit inquiries on your credit. So there is a rule in mortgage where you have a 30-day window of time to shop around with as many lenders as you want. So when I do my hard inquiry today, and that's day one, now I have a 30-day window of time to shop around with as many lenders as I want. And that's the equivalent of one credit inquiry hit to my score. Okay, so we'll get you this matrix so you can kind of take a look at it. If there's anything that applies for you there, you can kind of address appropriately. Now, student loans are things that come up in our conversations with clients. So as we're designing home buyer plans, a lot of clients will have questions about, student loans, how they impact us. And so I do realize that federal student loan debt has no payments required right now. I think the debts don't come to maturity or have payments, I think, till September. But when we're qualifying for a mortgage, we do have to take those into consideration when it comes to designing our financing. So when we look at student loans, there's a couple different calculations that we look at. And so if we're electing a conventional loan, so that's the Fannie Mae and Freddie Mac loan that we're going to talk about in just a minute, we by default use 1% of the aggregate totals as our monthly payment amount. If we're going to go with an FHA loan, it's 0.5% of the aggregate totals. Now, the guidelines also allow us to use what we call as an income-based repayment amount if we're signed up for that type of repayment agreement. So in this example I have on screen, if I have $75,000 in student loan debt and my payment's $250 per month, then I can use that income-based repayment instead of using 1% or 0.5%. Now, in some cases, I have clients that have graduated during the pandemic, right? So we haven't even set up an income-based repayment amount. In that scenario, we're going to have to either decide maybe we need to start the income-based repayment amount now or the agreement and sign up for that. Or we would have to go ahead and qualify with 1% of the balance for the conventional loan or 0.5% for the FHA loan. Now, on a conventional loan, we will allow a zero payment. So some of our clients have zero payment options on their student loans. In that case, we could potentially use that for qualifying. Okay, I'm going to take a quick check-in on questions here. So we had a question of, are there programs for low-income public workers such as teachers? So there isn't low-income public workers or teachers programs, but there is low-income housing options offered through the state of California. We're going to talk about that in just a bit. That'll be kind of at the latter stage of tonight's class. So stay tuned for more of that coming to you. Does anybody have any questions about the student loan calculations that I can help answer? So as we get a chance to move on in tonight's class, I just want to kind of leave you with this on student loans. Even though they're in forbearance, we still have to count a monthly payment against the qualifying. If you have a deferment, so like you're back in school working on maybe your grad work, we still have to count a minimum payment towards the qualifying. So these are things that we'll kind of talk through with you during a consultation to make sure we have everything designed properly. But it's a pretty regular thing that we're going to have student loans to be able to kind of overcome or just better understand as we design options for our clients. So that's certainly something we'll help you through. Okay, and then a question came in on student loans. Do you have to be on an IBR plan? So no, absolutely not. So it's really up to you. It's just what we found is that clients that are on an IBR plan are obviously going to have a lower minimum payment. So if instead of having that $50,000 in debt at 1%, so that's $500 a month, if I had a $250 IBR payment, then that's going to potentially make my qualifying a little bit easier. All right, so let's talk a little bit about different loan programs, right? And there's several different programs. There's probably hundreds of programs out there. In our classes like this, we'd like to focus in on 5 core programs, and most of our conversation, though, will center around conventional and FHA loans. So I want to kind of give you some just high-level information on each one of these products that'll help you on that path towards homeownership, and then we're going to do a little bit of a comparison of conventional loans and FHA loans as it relates to private mortgage insurance, which you've probably heard a little bit about. So let's talk a little bit about conventional loans. So conventional loans have a minimum down payment of 3%. So when we think about conventional loans, Fannie Mae, Freddie Mac type loans, and so those have a minimum down payment of 3%. Now, there is what we call high cost of living areas designated by Fannie Mae and Freddie Mac. And Sacramento, believe it or not, is one of those locations here in California. So when you go beyond the conforming limit of $726,000, now we go into this space called high balance. And that minimum down payment jumps from 3% to 5% when we get into the high balance space. But as long as we're below that conforming limit, it's 3% minimum down payment. Now, every year around November, Fannie Mae, Freddie Mac will update these loan amounts. And so we publish those out on our social channels and obviously share with our clients during their consultations. But these things get updated every year based upon the cost of living that obviously continues to go up. So Fannie Mae, Freddie Mac loans are also going to have a minimum credit score of 620. And so that's that's what we look at as part of the design of that product. Now, FHA loans are going to be stands for Federal Housing Administration loans, not necessarily just for first-time buyers, can be also second or third-time buyers. Minimum down payment is 3.5%. Now that 3.5% down is all the way up to $763,600. So that goes all the way up to the high balance amount here in Sacramento. And I forgot to mention to you, so each county has maximum loan limits for Fannie Mae, Freddie Mac loans, as well as FHA. So, if you do have a particular county, if you're not in the Sacramento market, we can kind of share with you what those loan limits look like for your particular market that you're considering. Now, FHA loans have a minimum credit score of 580. And when we think about the FHA loan, it's going to have a little bit more flexibility, a little more leniency from a qualifying perspective. And we're going to talk more about that as we compare that to the conventional loan. VA loans are going to be for our veterans that have served. There's a no down payment option with that. You can go to $1 million, $2 million plus with zero down payment option. Generally, for the veteran, there will be a funding fee, which if they're a first-time user is about 2.4% of the loan amount. And in some cases, if you have a partial disability as a veteran, the funding fee is absolutely waived. One of the cool things about a VA loan is even though I'm not putting 20% down, there is no mortgage insurance with a VA loan. USDA loans are going to be for our clients looking to buy more in the rural areas. So if you guys are here in Sacramento, maybe if you wanted to buy up in, let's say, the foothills, maybe Amador County, perhaps, that would be considered a USDA or United States Department of Agriculture area. Why I would maybe consider that for those areas, it might have a little more flexibility from a down payment perspective because you can put zero down. USDA does have some guarantee fees, both on a monthly and upfront basis. But there is restrictions not only from a geographical perspective, but also from an income perspective with USDA. And then you have your jumbo loans. And so jumbo loans are going to be for clients, which is not really common for our first-time buyers. But if a first-time buyer really needs to finance more than, say, $763,000, they could utilize the services of a jumbo loan. But the drawback is that down payment is going to be much higher. It's 10 to 15%. And not only do we have a higher down payment option, the asset requirement can tend to be a little bit higher because they do have reserves. And reserves, what that simply means is it's the amount of money I have available in my checking savings, maybe my brokerage, 401k account that's available after I've contributed my down payment. Usually it's 12 months equivalent of my monthly payment. So if I have a $5,000 monthly payment, 12 months times 5,000 is 60,000. So after I've contributed my down payment, my closing costs, I would need another $60,000 saved up. Okay. Not very common for our first time buyers, but certainly is a tool that we can use in helping guide our first time buyers. Now, PMI is going to be in place for clients looking to put less than 20% down. So PMI stands for private mortgage insurance. And what I find helpful in our classes is just to kind of show you a little bit more about the ingredients of mortgage insurance when it comes to financing, then just do a quick little comparison to conventional loans versus FHA loans. So a conventional loan PMI has a few different PMI options. You can pay it monthly. You can split the MI up, so you can pay some of it up front. You can pay some of it into your monthly payment. You can buy out the MI through what we call a single premium option. And then you can also do what we call lender paid MI. And that's not really common right now, especially in this high rate environment. And what that basically means is I'm taking a higher interest rate than the market to help create enough of a margin that I can buy out completely my mortgage insurance. Really wouldn't be something I would recommend in this market. Most of our clients are going to elect the monthly MI option. Now, PMI on conventional loans is based upon a few criteria. It's based upon your credit score, what your down payment is, and then how much you decide to finance. So, if I'm at the minimum down payment of 3%, but I have a slightly lower credit score, that might impact my mortgage insurance offering a little bit more. In fact, we have a little example here at the bottom for you guys to take a look at. So if I finance, let's say $450,000, my credit score was 740 and I had a 3% down payment, my mortgage insurance is probably going to be about $183 a month. So not as bad as you may think, especially for those of you that are maybe doing some home searches on Redfin or Zillow. What we seem to see quite a bit is those calculators tend to be a little bit on the high side. They're not necessarily calibrated with the different characteristics that we have here listed on the slide. And then one important feature of PMI with a conventional loan is it has a cancellation option. So once I achieve 2 years in my loan and I have 22% equity, I can potentially apply to have my mortgage insurance canceled on a conventional loan. Okay. Okay, so I got a couple questions in here that I'm gonna go ahead and just table these. So I did see your questions because a lot of those are things we're gonna cover. So I did see a couple assistance programs. So I'm gonna have Ken kind of bookmark those for us, and we'll kind of circle back to those in a little bit just so we can stay on topic here. But we definitely will talk about that stuff in just a bit. FHA loans. Let's talk about how that is on the mortgage insurance front. So there is two different components to PMI on FHA loans. So there's not only well, there is monthly MI, which is 0.55% of my loan amount. There's also upfront mortgage insurance, which is 1.75% of my loan amount. Now that also gets added on to my amount finance. With FHA loans, I cannot cancel my mortgage insurance unless I refinance out of it. So that's kind of a little bit of a drawback with FHA. Now, FHA just about 3 months ago made changes to the monthly component of MI. They brought that down from 0.85% down to 0.55%. So that's made that a little bit more affordable for homeowners. But there is a little bit more of expense attached to FHA. But when we look at it from the payment perspective, we see the same loan amount that we have compared to on the conventional side. PMI is about 206 per month on the monthly, and then we have to tack on this upfront PMI of 78.75. So that does increase our amount financed to 457, 875. So that can be a bit of a drawback as well too. So when you kind of take a step back for a second and say, well, why would I choose FHA over conventional? Because it looks like it's a lot more expensive on the FHA side. It just depends, because for every client, their situation might be a little bit different, because FHA is going to have a little bit more leniency. I think I mentioned this earlier, that it's going to have a little more leniency in the guidelines versus conventional. Obviously, you've heard a little bit about the credit score, 580 versus 620. But let's say I forgot to make that student loan payment 2 months ago. There was an accidental late of 30 days on my credit report. Conventional might be a little bit more challenged with that, where FHA could be okay with it. Or let's say I've had a bankruptcy 3 years ago. Well, conventional would require 4 years away from my bankruptcy, whereas FHA would only require 2 years. So those little differences, those changes in the guidelines may make a client, decide over one product over the other. Now, it's our job to obviously create a home buying plan for you that works and it's viable for you, that's going to create sustainable and affordable home ownership. And so we'll have to see which product makes the most sense for you. And as we design those product options, we got to take a look at some of the documents that we're going to need when it comes to income, right? So for our clients that are applying for a loan, there's going to be wage earners, which are going to be W-2 wage earners, and there's self-employed individuals. For our wage earners, it's pretty easy. We need the last 2 years generally of your W-2s, 30 days of pay stubs, and then we do various verifications of employment. And then for our self-employed individuals, we'll definitely need 2 years of taxes to show that we've been in business for 2 years. Usually a profit and loss statement and probably a balance sheet, and then some type of verification of the business, either through a business license, maybe a CPA letter, in fact. So those are the typical things that we'll ask for when we kind of determine qualifying income. Now, some of the questions that come up with regards to employment, I always like to kind of share in our classes, because this may be appropriate or applicable for those of you joining tonight's class. So one of the things that we hear a lot about, in fact, I just had this conversation today, which is, do I have to have 2 years on my job to be eligible for financing? And so you don't have to have 2 years. You have to show 2 years of employment history and or education. So let's say I just graduated from Sac State in the fall. I just started a new job the start of the year. Let's say it was in accounting, but I did a 4-year degree with Sac State. Even though I'm only going to have, let's say, 6 months on my job, I would still be eligible for financing, because my education actually counts to meet that 2-year requirement. So another example, in fact, the person I talked to earlier today, they worked in the industry for 6 years. They went and got a new job, been on that job for 1 year. We're concerned about qualifying. They can still be eligible because they have a full, over 2-year work history that can be applied. So those are things that come up. Now, when it gets a little bit challenging is sometimes we have clients that have dual employment. So maybe you have 2 jobs, right? You do have to show that you've been on both jobs for 2 years consistently. We see this a lot in the healthcare industry. So we have someone that, has been, working at one clinic for 30 hours a week, the other one for 20 hours a week. We have, in that case, to use both sources of income, we have to show that they've been on both jobs for 2 years. Okay. Now, in some cases also we'll have buyers that have a roommate that they want to count rental income for. If you're looking at using that proposed income for your next place that you're going to purchase, we won't more than likely be able to use that income unless we're using some type of niche program. Some of the first-time buyer assistance programs will now not count that future income. And if I have a partner that elects not to be on the application, then their income cannot be factored into my qualifying. I can only use the income for the documented applicants that are going to be a part of the financing. Okay, I know we have some questions on assistance programs, which obviously we're going to talk about in just a little bit, but I just want to, is there any questions around income or different scenarios that I can talk through with the group? Okay, and I know it takes you a little, if you do have a question, feel free to type that in the chat or Q&A, and I'll obviously go back to that. But I want to stick with income just for a minute. Actually, we did have a question. Could disability used as income? So yes, disability income could be potentially used. We would just have to look at the duration of how long that disability income will continue. So we call it a continuance in underwriting. So thanks for the question on that. When it comes to qualifying income, we also look at your pre-tax income for our W-2 wage earners versus monthly obligations. And we have this calculation called debt to income ratio. You may have heard about it. Really simple calculation. It's just going to look at that gross monthly income versus our monthly expenses. What we take into consideration with that is personal loans, credit cards, auto payments, student loans. Those all get factored into debt to income ratio. Usually the maximum debt to income ratio is 45%. In some cases, we can go as high as 50%, believe it or not. We have to really kind of think through that a little bit as we design home buying options for our clients, because we really want to make things as affordable as possible for our clients. And so, when we get to that 50% level, that can be a challenge because we don't necessarily take home what we gross. So we want to make sure that we design something that could work for a buyer. Now, this is the calculation here for debt to income ratio. Principal and interest, the property taxes on my house, as well as homeowners insurance. I'm also going to factor in PMI. So if I put less than 20% down, that PMI, if I'm purchasing a condo, maybe a townhouse, sometimes a single family residence, we have HOA expenses or homeowners association. And so let's say that's $2,500 a month. And if we have other debts that are $500 a month, so now I have $3,000 in expenses. And then I have, in this example, $8,500 in income. So now my debt to income ratio is 35.29%. So a lot of our clients, feel really good, I guess, if you will, at 33 to 36% debt to income ratio. In some cases, clients will feel a little bit better at 45. Our job is to create basically a program, like I said earlier, that's sustainable and affordable for you. So debt to income ratio is just a calculation that we use to help really understand qualifying, not necessarily on the affordability side. Okay, so the last stop we're going to make on tonight's class is going to be on assets. And so that's for assets for down payment. So we've talked so far a little bit about, how credit impacts us, the different programs that are available to us, and how MI or mortgage insurance can be involved. Talked a little bit about employment and obligations. Well, then last step in designing our home buying options is going to be around assets for down payment. So this is the documentation typically that we'll ask for. So checking and savings accounts, we can't use cash deposits. Everything has to be paper trailed when it comes to financing. Potentially 401ks, 403bs, even IRAs can be used for your financing. But I would just really encourage you to talk to your financial advisor, maybe your tax advisor, because you can have some tax implications by accessing some of those assets. In some cases, gifts can be used. Now, that doesn't require any type of seasoning on gifts. That's where a family member has contributed towards your home purchase. And so there is no 60-day requirement, those being in your account or anything, but there is a documentation process for that. We'll generally need a donor's letter that we provide the template to, and we just have to show those monies being transferred from the donor, either into the escrow account or to you. Now, as we learned earlier, the minimum down payment is 3% for a conventional loan, 3.5% for an FHA loan. And quite honestly, that can be challenging for many of our first-time buyers. And so one of the things that we're really proud to offer is first-time buyer assistance programs. We happen to be the #1 provider of CalHFA assistance across the state. We have been for the last several years. we get a chance to be able to contribute into our local communities by creating that sustainable and affordable home ownership. So in our workshops, I always like to kind of include this part of it to kind of better understand a little bit more of your options, to maybe think more about home ownership being more of a near-term goal for you versus being more of a long-term. So let me walk you through the different program options, and I'm gonna kind of give you a little bit of a glimpse of the California Dream for All program, because I'm sure you've probably heard a little bit about that. It seems like everybody has, and kind of give you some more background around that. So the first program is the My Home Assistance Program. That is a staple program with CalHFA. So that is always part of the CalHFA budget. It does not come in and out of the market. So it's always around, and it provides up to 3% assistance for a conventional loan, 3.5% for an FHA loan. And what that is, it's a low interest rate loan at 1% simple interest. You do not have to pay back the assistance until you either decide to sell the home or if you decide to refinance in the future. So that can help with your down payment. And maybe you say, hey, Jason, I've already had my down payment, I'm good there, but I really can't afford closing costs. You can use the My Home towards closing costs as well too. And speaking of closing costs, the ZIP Assistance Program, also called the Zero Interest Program, can provide you 2 to 3% of your loan amount that you can add on to the My Home Assistance Program. It's a zero interest loan to help reduce costs on closing costs. Now I will just say, in today's interest rate market, it's very difficult to have the ZIP assistance make sense because it actually elevates the cost of your first mortgage interest rate by about a full 1%. One of the great things about CalHFA is the interest rates are super competitive. Even though rates have kind of gone up today, we've seen rates with the CalHFA program as low as 6.125 over the last couple of weeks. Now rates are pushing into the 7s now, but the program has been super competitive from a rate perspective. But just to kind of clarify here, the My Home Assistance Program can be used first. And then if you really wanted to add the ZIP Assistance Program, you could use that as kind of an add-on feature. Now, the California Dream for All Shared Appreciation Loan, in case you have heard about it or haven't, what that was kind of more of a niche program, if you will, for CalHFA. Funds were allocated. In fact, $300 million was allocated from the state general fund to help fund that project earlier this year. And you may have heard in the news, I think everybody heard about it, those funds ran out in 10 days. It was just an overwhelming success. We helped, I think our office helped close to 60 buyers with that program. I think overall there was close to, 2,300 families helped with the program. So it was a great vehicle towards homeownership. Now, many of you have maybe on the distribution list for CalHFA. That program does have a second wave of funding. It was allocated another $200 million from the state, but the allocation is all we have right now at this point. There is going to be what I'm kind of calling a version 2.0 of California Dream for All, but that program has to be revamped. So over the next several months, we're going to be meeting with leadership team members and our project team to help kind of that redesign. And so we'll be kind of pushing out information as we receive it, but I think the second wave is probably not going to be available, if we're lucky, until end of the year, possibly the first of 2024. Okay, but stay tuned for more details on that. It's a super creative product. It's helped a lot of families get into homeownership. But I think, as we wait for that, there's still amazing programs available, like the My Home Assistance Program. And so I want to walk you through an example of that, how that could affect homeownership for you today. So if we were to take a home value or home price of $450,000, we have the minimum down payment of 3%. So that's $13,500. We also have to factor in those closing costs that I mentioned. We're probably going to need about $22,000 to $27,000 out of pocket to purchase that home. So for a lot of our clients, that's kind of a stretch because most of our clients have maybe 10, 12,000 set aside. So $450,000 to set aside $22,000, probably not doable. But when we factor in the My Home Assistance Program, and now we get that $13,500 to help offset that minimum down payment, now it might be a little bit more attainable because now all we have to worry about is just those closing costs, maybe $19,000 to $13,000. Or if we want to bolt on the feature of a ZIP assistance program, we could lower those funds even further that we'd have to put out of pocket. So when we think about homeownership, it can just make it so much more achievable for us using a product like the My Home Assistance. FHA has the same tool under CalHFA. So the only thing we're doing differently here, we're taking that 3.5% minimum down payment, and now we're going to plug in a little bit more My Home Assistance because that's the minimum down payment for an FHA loan. But the same out-of-pocket principles would apply. Now, there are income limits with the CalHFA program. In fact, they were just updated based upon cost of living across the state. Most of our Bay Area counties didn't see any adjustments, but we did see some adjustments here in Sacramento and the surrounding counties. So you can see on screen, Sacramento's at 225, Yolo's at 225, and Placer 225, and so is El Dorado County. So those are up about 23,000 or so, give or take, year over year. So obviously, that's super helpful. It makes it a much more inclusive program for first-time buyers here in California. Now, here are the eligibility requirements. It's a minimum credit score of 640 for the FHA product, 680 for the conventional loan. Now, there was a question that came up in the chat, and that was around, is there any low-income housing options? Well, CalHFA does have a low-income housing option. What it means is if I'm less than 80% of the median income in the county, then I get a interest rate reduction. Usually it's about a 0.25% reduction. And my assistance qualifier is credit score drops down to a 660 score on a conventional loan versus 680. So the median or the AMI median income has increased as well. I'll have to pull the numbers on that, but I think that just increased. I think it's right around 108, I want to say here. But I'll have to kind of check back with you guys on that. But that's an availability for low income housing. So that's offered through CalHFA. Debt to income ratio requirement, 45 to 50%. Now it's interesting with CalHFA, most first time buyer programs look at total household income, where CalHFA only looks at applicant income. So that's an important feature there. And a first-time buyer is someone that hasn't owned in the last 3 years. So you may have a rental property in Texas you've owned for the last 10 years. If you've never occupied that home as your primary residence, then you're still considered a first-time buyer. And this is eligible for single-family homes, condos, townhouses, even manufactured homes, but it does have to be on land that is owned if it's a manufactured home. Now, another question that came up in the chat was about the Biden federal assistance program. So that program is still kind of in a stalling pattern. I think I've heard about that for the last couple of years. There is no implementation or sign off of that assistance program at this point. It's honestly, in my years of working on the first time buyer front, I haven't really seen much on the federal side in assistance programs. Usually it's either city driven, county driven, or of course at the state level. But certainly if we hear anything that's out there, we'll definitely report back to you guys. But right now, at least what I've seen in the market, the most lenient in providing the most inclusion right now is the state assistance program. But certainly if you do have programs in your local markets, right here in Sacramento, we have the Sacramento Housing Redevelopment Agency, also known as SHRA, has some fantastic programs, but it's a little bit more challenging because they're a little bit more restrictive from an income perspective. Okay, as we're getting ready to get to the close tonight, I want to spend some time looking at the process of buying, because that's really important to understand, like the milestones that we're going to go through in the buying process. So let me walk you through that. This is the kind of a visual aid that we have to take you through those milestones. The first milestone is pre-approval. So that pre-approval is the outcome of or output of our consultation that we do with you. By the way, a consultation is a 30-minute session that we do over video with you. That's what we do throughout the day, meeting with clients, designing home buying plans. Once we've created that design, then we issue a pre-approval to you. The pre-approval is good for 60 days. That allows you to get out into the market, start kind of a little bit more seriously looking at homes. And that'll move you to the second phase, which is house hunting. That's kind of the fun part of it. You get a chance to go ahead and take a look at some different homes. And then maybe now you're not doing the online search. Now you can go out and physically tour homes. And if you decide to present an offer to a seller, you have that pre-approval to provide with your offer. And usually you're going to be partnering with a realtor in your home search. And we have a fantastic network of preferred realtors all across California. So not just in the Sacramento area, but Southern California, Bay Area, all Northern California markets. And as I mentioned earlier, realtors are paid for by the seller. So whether you use one of our preferred network realtors or someone on your own, I encourage you to take advantage of that resource. Now, let's say I find a house that I really love and I want to make an offer on the house, and then the offer gets accepted. We had several buyers that, believe it or not, had their offers accepted today. Well, guess what? That moves us to step 3, which is entering escrow. So the seller has accepted our offer. Now we have some action items on our side. So we have to make an earnest money deposit, which is usually in the first 2 to 3 days of the escrow time period. I'll show you what an earnest money deposit looks like in just a minute. And then we're going to reach out to you from our team, congratulate you, get you scheduled for a follow-up consultation. And that's where we get back on video again to make sure you feel comfortable with the new design of your financing. Make sure you understand your payment, your out-of-pocket expense, of course, your product options, any assistance programs that we're going to elect. We're also going to start the processing of your loan, which includes ordering your appraisal of your house. And we will get everything kind of prepped for your follow-up consultation. And then after the follow-up consultation, we deliver to you disclosures that are provided to you that meets all the regulatory requirements. Now, you may ask yourself, what's an earnest money deposit? Well, that's kind of a good faith deposit you make upon acceptance of the offer. It's usually 1% to 2% of your purchase price of your home. Now, those deposits that you make are protected in what we call the contingency period. The contingency allows a buyer to do their homework on the property, which includes you want to get a house appraised, which we'll order the appraisal for you as the lender. We'll get the house inspected, which your realtor will help organize that. And then, of course, we'll get your loan approved through us being the lender. In case you don't know, we are the lender in the transaction, so we're a direct lender. So we're making our own financing decisions as we kind of help design your options here for you. So that's called the contingency period. Now, as we move through these milestones, we now go into step 4, which is the processing and the underwriting of the loan. And that's where we're verifying your employment. We're verifying maybe the assets that you're going to use for the transaction. We're probably going to be looking at getting your interest rate locked, especially in this volatile market. We want to make sure that's all taken care of so that you have peace of mind that your payment, your interest rate is kind of what you've expected to be. And then we go to step 5, which is loan approval. That's when we have your loan approved by our underwriting team. They've reviewed all your income and assets, make sure that everything is in line. Now, it also brings you to the end of your contingency period. And a contingency period is usually in the first 14 to 17 days of the contract. So now when we get to step 5, we've probably done all of our due diligence. We've got our inspections back from our realtor. We have the appraisal back and the loan approval. So if everything kind of checks the box for you, then you basically have the okay to remove your contingency. But what's important to know about that is once I remove contingency, that tells the seller that I'm kind of all in, like I'm good with the property. I'm in, I want to move to the closing phase. And speaking of closing, we're going to deliver to you now a final closing disclosure. And that gives you a 3-day cooling off period before you get to the very final milestone. And that's called closing the loan. And that's something that you're going to be doing where you're signing documents in person with the public notary. Everything up to that point is all done via e-signature. So that's the one thing you still have to do. It's kind of an old school process where you're going to meet with a notary. Usually takes about an hour to hour and a half. They'll collect signatures. They'll notarize all your documents. After that's happened, then you're going to wire in funds for your home loan, whatever that amount is. You'll have that number in advance of that meeting. And then after those funds are transferred over, we as a lender will do one more audit of your loan, then transfer in the funds. We call that wiring in the funds for the loan. And after that money is all settled into the escrow account, it's all balanced out. So we have the seller receiving the funds that they expect from the sale of the home. You've contributed what you're supposed to as a buyer. Then that money is all confirmed. And then what they do is they transfer the documents to the county recorder's office. In fact, the recorder's office is right around the corner from us here in downtown. They record a grant deed, which is your transfer of ownership, and they record a deed of trust, which is your agreement to repay the loan. And so once we get confirmation of that, you become the official owner of the home. I'm going to call you right away and say, congratulations, give you that virtual high five. And we did it. You know, it's probably the most enjoyable part of my job is to be able to say, hey guys, we made it happen. Now you're new homeowners. And we love all the testimonials and stories that, you know, our clients share about their experience once they get those keys. That's again, one of the most fulfilling parts of our job. And so, you know, many of our classes that we've taught over the 7-8 years that we've been doing this, we have graduates that have gotten the opportunity to achieve their dream of homeownership and get those keys like I just described. But it does start with kind of a consultation to help design the plan. And so you may come out of this class and say, hey, Jason, I want to help. I want to design something. I need some help to get on that path towards homeownership. And that could be, you know, a this year goal, could be a next year goal for you, whatever that is. We're here to help serve you in homeownership. And so it really starts with the simple process of doing an online application, uploading some documents, and then meeting with us and scheduling that through our scheduling tool. And maybe you have some questions after tonight's call and you're just, you know, I got a particular situation I want to run by you guys. feel free to always schedule an introductory call. We try to make ourselves available for our clients to be able to kind of go through those different scenarios. Here's what a consultation looks like. It's just a basic kind of walkthrough of, where do I want to buy? What does my budget need to look like? What's my credit need to look like? Are there areas of opportunity there? What's my debt to income ratio look like? What programs could be the best fit for me? Those are all included in that consultation. That's a free service we provide. So there's not an expectation other than, we want to help kind of get you on that path towards home ownership. And we got some great resources that are available to our clients as well, including our mobile. So you can start all of your process via mobile, but if you want to use it through the calculator function, it's a fantastic tool there. It's available for Android and Apple, and we have the links here for you. Again, as I kicked off tonight's class, you're joining us probably because of our wonderful partnership with Sac State, but we also have other partnerships across the country that we're super proud of, and we get a chance to participate in classes just like this for them on a weekly basis. So, if you have friends, family, maybe some coworkers that think might be useful information for them, we'd love to have them check out a class. Our full list of classes are available at mortgageeducate.com. Now, I do have some classes, I got some questions in the class that I wanted to answer before we wrap up tonight. I know we have some people that are hanging on there for us. The class will all be recorded and available on our YouTube channel too. So in case you missed some of this, maybe joined a little bit later. But I do want to answer some questions and keep it open for any of our audience members that have some items here. What's that? Okay, perfect. So I think the first question I had is just a quick question around VA loans and how VA loans are used. So VA loans are going to be for our veterans that have served. And so for the VA product, you generally have a certificate of eligibility that is going to be obtained for you as a veteran. And then we'll get the certificate of eligibility for you, but usually you'll have some type of discharge notice like a DD-214 that we'll use to obtain your certificate of eligibility and determine if the VA product is the right product for you. During our consultation, we'll look through different scenarios with the VA product to see, how the best design would be for that. Okay, and we just put in the chat our scheduling link, so feel free to check that out if you do want to get on the calendar to be able to get a chance to maybe go through that home buying design for you. Or like I said, if you have some questions, we'd love to be able to be available for you on that as well. Let me see, I think. Okay, then we had another question that came in. Is the IBR something that is addressed from the student loan servicer? So yes, so the IBR, income-based repayment, is something that you'd have to set up with your servicer. So whoever your servicer is, you would reach out to them and say, hey, I want to look at my income-based repayment options. They're going to require you to submit some proof of income, obviously probably your last year's tax returns. Now, right now, it depends on how long you've had your student loans, but some of our clients have income-based repayments going into the pandemic, so those are still at the same level. Right now, we can still use those income payment arrangements or income-based repayment amounts. So, but if you need to set up one or get recertified, then whatever that new payment is, that's what we use for qualifying purposes. Okay, great question. Any other questions from the audience? And we have a lot of, okay, we got another one that popped in here. So here's a great question. So question was basically, I'll kind of summarize it. So we want to start with working with a loan team before talking to a realtor. Yes, I would encourage getting qualified first for financing and then getting connected with the realtor. Now, it doesn't always work that way because, there may be a realtor that you connect with first, or maybe you've done a search and you like this particular house, and then it's kind of about finding the financing to meet what you're looking for in your search. But I would encourage you to get connected with us for financing first, because then you'll know exactly what your budget looks like. So when you do decide to go out in the market, you know exactly, what options you have. So, and I think I have a follow-up VA question, is how is the $1 million addressed in the VA loan? How is it calculated? So the calculation, we have just a baseline number there for the VA loan. In some cases, you can go beyond $1 million. in financing. And during your consultation, if you decide to take the next steps, we'll kind of go through the breakdown of what that $1 million loan amount might look like for you and the overall qualifying. We actually originate and fund the VA loans directly. So servicing will depend on, because that was the second part of your question, that will be dependent on some of kind of the finalization of the financing. And then question was, with VA financing, or sorry, FHA financing, do you have to pay the upfront PMI and the monthly PMI? And so the answer is yes. So as I shared on the slide earlier, so you have upfront mortgage insurance and you have monthly, but the upfront mortgage insurance is a one-time premium that gets added into your total amount financed. And so question was, how do you pay for our services? So there is no cost for consultations for our services. So there's no upfront charges. Obviously in lending, in the lending world, we're compensated through, or the organization earns money through the interest costs. But in terms of consultations, anything like that, there is no cost for our services. But a good question though. So question was, how does HFA come about and how is it similar to Section 8 and HUD homes? So HFA has no relation to Section 8 and HUD homes. So HFA stands for the Housing Finance Agency. Section 8 will be discounted options for low-income housing renters. And I think there's a coupon available for owners, future owners. And then HUD homes are going to be homes that are designated for possibly for low-income housing, or could be FHA loans that were foreclosed on. So that's completely different kind of completely different section. Okay, great questions. Any other questions I can help answer from the group? And the question is, can you be eligible through HUD homes with the VA loan? So it depends on the designation of the HUD home, if they're going to offer it to the general population or it has to be through FHA. Are there any loan programs for healthcare workers and are dental hygienists included? So there is no specific healthcare worker programs that are available out there. There is a medical professionals program that's for dentists and doctors, but I kind of hesitate with that program. It hasn't been as advantageous for medical professionals because the kind of the standard conventional programs seem to be a better fit. The advantage with the medical professionals program is it didn't count student loans into the debt to income ratio calculation, but I think the trade-off doesn't make sense for a buyer at this point. Okay, so we got some more questions that popped in. Can you get an FHA loan on a condo? Possibly, but the condo has to be on the FHA approved condo list to be eligible. There is some cases spot approvals that we can do with FHA, but that can be a bit of a challenge at times. Usually for condos, we're going to be looking at conventional financing that because they're going to be a little bit more flexible with eligibility for the community. And so question, what's the difference working with a bank versus a company like ours, APM? So when you think about Chase or Wells Fargo or whatever the banking institution is, so they're going to have obviously a captive audience. Their depositors are going to be those that they serve. They may have a little bit more restrictive guidelines per se, based upon how they decide to lend. APM is going to be what we call as a direct lender. So we sell directly to Fannie Mae, Freddie Mac, to FHA, but we also partner with some big banks in certain products. And we tend to be a little bit more lenient than banks. But everybody has different types of product lines, but for the most part, banks and APM, which was again as a direct lender, will have some similarities. But there may be some subtle differences when it comes to guidelines and interpretation of guidelines. And another question was, there any assistance for state employees? There's no state employee assistance programs, but of course, if you're in California, there's the HFA program that we reviewed earlier. We also have a state discount program. So if you're a state employee, It's the same discount program as the Sac State program. So if you're an alumni of Sac State, then you'll have the discount either way. VA loans are only eligible for homes or apartments and condos included. So VA loans can be single family homes, they can be townhouses, condos, even in some cases, multifamilies. So another question was, when can you lock in your interest rate? So you can lock in your interest rate generally when you have an accepted offer. All right, and then great questions, guys. How does 529 plans work into first-time home buyers? So, I think, and can you just kind of elaborate with the 529? Are you looking at, if you can just kind of give me a little bit more information on that, I'll answer that on air. Maybe just give me a little bit more clarification on what you mean by the 529. And then, if I put down 20% down, can I only qualify for conventional loan? Is the question I just got. So not necessarily. You could look at different products like a jumbo loan, for example. FHA, I wouldn't recommend unless you had to go that route, because with FHA loans, even if you put 20% down, you'd still have to pay mortgage insurance. So it would kind of defeat the point of putting that 20% down. So we would probably look at conventional, but that's something we would have to talk about in the design of your financing. This person elaborated a little bit more on 529. So, okay, you're thinking about it more towards college savings. So the 529, you have to talk to your financial advisor, because I'm not an expert on 529 plans, but I don't know if you can redirect towards the home purchase. But if you can, I don't see why that can't be used as an asset towards down payment. And it can certainly be coupled with any type of assistance programs if you decide to go that route. You stumped me on that one. I haven't got any 529 questions at all. So, but I would definitely talk to your financial advisor for sure. All right, great questions tonight. All right, and a lot of you still hanging out here. So, any other questions I can answer before we wrap up tonight? Okay. Well, as I leave you this evening, I wanted to kind of share with you all my contact information on screen. If you do have any follow-up questions that didn't get answered tonight, don't hesitate to reach out. We have all of our contact information here. Really encourage you to kind of check it out and see what our clients are saying about us on some of our reviews online. And we do post a lot of good information for first-time buyers, especially on our Instagram. So you can follow us at JMADA Mortgage, especially some updates as we get more information on the California Dream for All program. We'll be posting that. We try to get posts out at least weekly to our followers out on Instagram. But yeah, always check back in with us if you do have any questions about any type of product updates that are coming along. So with that said, thank you so much for joining tonight's class. We hopefully get a chance to see you soon. Please feel free to reach out to us if you have any questions. Have a good night.